Welcome to the Life Self-Mastery Podcast, where we bring in entrepreneurs who have created online businesses and improved their lifestyles. Here's your host, Rohit Malhotra.
Hi everyone, this is Rohit from Life Self-Mastery, and today I'm excited to have Adith Podhar, who's a managing partner at Gemba Capital, which invests in angel rounds and tech-enabled startups focused on India consumption and cross-border SaaS. Prior to this, Adith worked at Motilal Oswal PE fund in Mumbai and had an entrepreneurial venture called Cafeteria, which is a chain of quick-serve restaurants operating in Mumbai, Hyderabad, and Pune. Welcome to the show, Adith.
Thank you very much, Rohit. Thank you for having me here.
Awesome. So how did you get into this crazy world of venture capital?
Oh, my first exposure to PVC space was actually in my first job at ICICI Bank, wherein I was part of the international banking division, where heading the alternative investment asset class. So there our role was to come up with newer products for our relationship managers to sell. And that is the time where we launched a private equity fund for our relationship managers to sell it to HNIs and NRIs globally. So that is where I kind of first got my understanding of how a private equity fund works, what's a roadshow, and how things are done. So that is where my first stint was. And then I went into become an entrepreneur in the QSR space. I ran that business for 4.5, 5 years. Post that, did investment banking for a couple of years, which was more on the sell side. And I wanted to move on the buy side. And that's where I joined a private equity fund, Motilal Oswal, where I saw the entire cycle from investments to exits. And that is where really, I started really liking and loving the entire PVC investing space. And from private equity, I started my second entrepreneurial venture called Gemba Capital, and moved to early stage tech investing, tech-enabled businesses in investing in them. And that's how I am right now into this space, right? And that's how I got into it.
Right. Really interesting because, you've been a founder and operator and you've worked in a PE firm and now into VC. But how did your mindset shift from investing, in a PE fund to a venture capital fund?
Oh yes, initially it was very difficult, because the definition of risk actually changes when you invest in a classic private equity deal compared to a VC or an early stage investing space. And initially it was very tough to change that mindset because there are no numbers, there are no financials. The product is in an MVP stage. There's just small amount of traction. So you can't really use your learnings of private equity to kind of make an investment. You'll never be able to. So at private equity, we used to look at cash flows, free cash flows, capital allocation skills of the founder, ROC, ROE. So it's completely different, right? I think the way it changes is it becomes more of a founder assessment. It becomes more of a art in a way I say, more than the science. And the focus goes more on the founder market fit, the product, how the market is, what are dynamics, what's the go-to-market strategy. These kind of things sometimes are not applicable in a PE fund wherein the founders are already achievers, they already have a market share, they already have a product which is doing phenomenal numbers. So that's the difference. The things which you look out for is very different in a PE space versus a VC space. Here you are looking at more hustlers and growth mindset founders, right?
Right. Right. And, these are definitely testing times. So I wanted to understand that, on Twitter space, it's been said that VCs are open for business. And I wanted to understand, are venture capitalists still writing checks, and how has the deal flow impacted in these times?
See, if you look at any VC structure, there is no really a liquidity option in the middle of the fund for an LP, right?
Right.
So all those VCs who already have dry powder will continue to invest. They might slow down their investments to assess the situation and to rightly so focus more on their portfolio companies. They might increase their reserve allocations to follow on investments in their existing portfolio companies, which are good but probably are facing a tough time. So to that extent, some slow will happen in terms of new investments. But having said that, investments will continue VCs will always be open for business. In fact, post-COVID, a lot of good startups will again go back to a fundraise mode and go back to raising capital. And I'm sure VCs will be ready for that. In terms of deal flow, yes, again, temporary dip in deal flow. Major reason for it would be that even startups have realized the new situation and know that this is not the right time to go out and raise funds because there would be probably a valuation cut or probably a flat round. So they would also first try to cut their costs, remove all the unnecessary flab they have, and then try to extend their runway, and then probably go out for a fundraise. So, and also to that end, their business model will also probably become more sustainable and more, the path to profitability will be probably more clearer by then. So, yeah, there will be a slow growth on the deal flow side as well, but it will all be temporary.
Right. And, I wanted to understand about B2B and B2C marketplace, because I think definitely, I mean, most of the sectors have been impacted, but how's the B2B and B2C world has been impacted by COVID? And what steps would you recommend for founders to, come out of it?
See, the way I see B2B and B2C, it's not about B2B or B2C. It's more about the industry and the sector, which in some certain cases will get high impacted, and in certain cases it will not get impacted. Like consumer discretionary probably will obviously get impacted, right?
Yeah.
But if you look at it, it depends upon where you are in the value chain, right? In the end, it is the consumer, the human, the man who's kind of spending and consuming, right? So if you are a B2C business, you will be the first to get impacted and probably the most to get impacted. But in the value chain, again, there are a lot of B2B companies, right? So for example, if you are an auto OEM, right, you will get impacted first, but then the next impact will be on the B2B auto ancillary. And then the next impact would be on probably a component or a system supplier. And then the one which is probably supplying the commodity, the steel, the aluminum, right? So the earlier you are in the value chain, probably the impact will be probably a little lower or it will come a little later. But in the end, all of the companies will get impacted. If someone in the value chain delays payments, it will go on all the way till the first guy, right? So in these certain cases, the companies which are more diversified, have multiple sources of revenue, multiple industries which they serve, those are the ones which will probably survive this COVID impact much better than others. And coming to your question about what steps need to be taken, I'm sure there are so many webinars already out in the market of people advising what steps to be taken. But really, if you go to see, these are the same things that people are talking about, wherein you just kind of in bad times don't kind of move too much, just try to do as less as possible, consume as less as possible your energy, your cost, your resources, your money, and try to kind of sustain and rethink, recalibrate the market conditions, your strategy, your fundraise strategy, everything, and probably go ahead. So it's a good time for founders to actually take a step back, go back to the drawing room, and rebuild, right, with a different perspective and a different market condition.
Got it. And I know it's important to survive and go through this next 3 to 6 months and basically go back to the fundamentals. I wanted to understand what are the core questions that we see ask a founder when they're looking at valuations. Do you think valuations are really important when you assessing an opportunity?
So again, that depends upon what kind of an investor are you. So for me, let's say if I'm a very, very early stage investor investing in seed rounds, sometimes valuation does not matter, because for me, I need to, it's better to invest, let's say in a Google at 10x the price of what I would have thought with the right price, than to miss out on not investing in Google, right? The opportunity cost is much high. So it depends really on the fund strategy. Anything which is abnormally high is obviously indicating and signaling many other things about the founders. So that's a call you take. But for early stage VCs, my recommendation would be that valuations do not matter so much. as it matters to a private equity investor who probably just will look like how public markets are reacting, what are the public market comparables, whether will I make my 30% IRR on at this kind of a valuation, will there be a multiple expansion or just the growth which I need to kind of capture in the model, the projections, do I need to discount it further considering the new situation? So all those questions, all those things do matter for let's say a growth or a mid stage VC, but for early stage the questions still remain the same about the product, the market, the founder.
Correct. And since you're early stage investor, what is important to you? Is it the market or the idea or the person you want to invest into?
So this is always a question which is always debatable. Each fund and each investor has a different view. For me, what is more important is the market and the founder. The product or the idea actually is not so important at the stage which I invest in. For me, it is critical that the market is big. That's it. And then what is more important are the founders, because there are so many unknown variables when I invest that I am more dependent upon the captain of the ship to kind of steer it to a certain level till an organization is built and a second layer is built. So it is important that how the founder market fit is. And eventually, if the founder is great and high quality, even if the product is not correct in the initial MVP stage, it can pivot, it can kind of move to a different level, it can change. Even the markets probably you can change, but in terms of pivoting the entire market, but founder remains the same. So for me, founder is important, and then obviously good market, because even if you're a very high quality founder, but if the market is poor, the market will win then.
Right. And, I worked in a SaaS company and a marketplace and a tech company, but what advice would you give to founders on the go-to-market strategy, pertaining to some of the portfolio companies do you have? What suggestion do you have for founders?
See, the way I think about it is first identifying your TAM itself, right? That's the most critical part before you kind of decide on how to go to market. As Peter Thiel has put it, it's better to, if you have a strategy in place to capture 10% of a very, very small micro market, rather than directly aiming for 0.1% or 1% of a very, very large market, right? First, get that right. You will see initial signs of early product market fit. You will see signs of customers loving your product. You will see signs of your playbook getting built, right? And that's the time you kind of then go out and raise further growth capital and go out to other markets or try to go capture deeper penetration and expand the market. But initially, it's important for the founder to actually make mistakes, experiment initially, but get that thing right before expanding too fast, too quickly. It's like you need to know how to kind of walk before you start running, right? And once you've established that, then you can probably go into other spaces. In fact, I'll give you an analogy here. Like for example, if I'm a founder and if I see a large tree in front of me, right, and which has a lot of fruits, the first thing I'm going to do is pluck the low-hanging fruits. Isn't it very obvious, right? I pluck that. Then what I'll do is then I have to stretch probably to get the other fruits, right? So I have to probably put in some more efforts to get and stretch and get the other fruits. Now, beyond a point, I can't even stretch beyond a point. So I would probably need a ladder to get those fruits which are higher up, right? Once I get those, then what? Again, I need to change, add some feature, get some tool, get some technology, get something to go to get fruits which I'm not able to reach even with a ladder, right? And then eventually, probably the tree does not have enough fruits and I have to go and look at the other tree as well, right? So that's the way probably at every step you build your product and your journey and try to capture the market.
Right. And are you sector agnostic, and do you have any sectors which you feel you're more bullish on?
Yes. So overall, we're very sector agnostic because I do not want to at this stage take suboptimal bets by investing in a very niche or a segment or a small segment. But having said that, we can't go into depth of every sector if we become very sector agnostic with a small member team the way we have. So we've identified two areas. One is SaaS. We really feel that India's time has come for SaaS, and there will be many more unicorns in SaaS space because we're building fantastic products right here in India and selling it globally. So those are the businesses which we really love and we're focusing on. And second is the domestic consumption really, whether it's tier 2, tier 3 cities, whether it's the budget category, the middle or the lower middle class, where there are still so many problems not yet solved. And now you have the entire infrastructure and all the levers for these markets to kind of grow into large markets, and you like founders and products which are kind of serving that segment. That could be either in edutech or fintech or agritech, doesn't matter. But that is one area, large opportunity which we feel we'll look at investing in.
Right. So interesting you pointed about SaaS companies, and we got Freshworks and Druva and few other companies which are valued at $1 billion. So in next couple of years, what would a SaaS founder need to do so that he's not only restrained to India and Southeast Asian countries, but also go global?
See, one thing is every few years the playbook changes. You can't, if you're a SaaS founder in India and working on a playbook which is 10-year-old, probably you will not work, right?
Right.
You need to change that. And how you need to change that is to kind of have a clear understanding in terms of how the market is moving, what are customers buying, who your customer is, very, very strong understanding of that. And then kind of build your business around that, and a business model which has its own legs. Like for example, there was this trend of all the enterprise products, all the consumer products were becoming in the end going to enterprises as well, like Zoom for that matter, or Slack for that matter. Started off with as a consumer products, but becoming an enterprise product.
Correct.
So how things are getting different, like you hear about Superhuman taking 2 years to launch the product, right?
Right.
Which is completely different from fail fast, launch fast, ship fast, and then learn and then relearn and then change. So things keep changing. You need to kind of, if you want to succeed, you need to know what's going to work at that time, how behaviors are changing, how adoption is changing, who are the people who are the new breed of people who are going to adopt your product. And then, once you get all that in place, there is a recipe for success.
Right. So, I wanted to understand about your reserve allocation on the startups you've already bidded, since it's a young fund. So, what are your thoughts on how do you allocate capital?
See, the way I think is, I have kept a number of 2x in my mind, which is basically 50% allocation for reserve allocations. So if I'm investing 100K in a company, I should have another 100K to invest in that company. I know some people would probably recommend a higher reserve allocation, probably 70%, 60%, but I think a 50% reserve allocation is good enough, because I also need enough money on hand to build the initial portfolio, right? Because if I am short of that, then I do not have the probability of getting a rocket ship in my portfolio. So there's no question of reserve funding, or probably I'll have to then cut too small a check to increase the number of companies in my portfolio, which probably I would not want to do it. So hence, to kind of maintain the balance, I have kept a 50-50 kind of a number for reserve allocation. But yeah, you need, I think that is one area which a lot of people don't realize, that you need to double down on your winners.
Correct. Yeah. I mean, if somebody is able to grow at an exceptional space, it makes sense to invest more into that startup.
Yes.
Right. And interestingly, in last 2 months, all over the world, people have been forced to become remote. And what are your thoughts, other than using the usual products like Slack and Zoom? What is it that a founder and employees would need to do so that the morale is up, and the remote work culture can really be part of the culture?
See, one thing clearly which COVID has kind of impacted and shown to the world is that companies can function with a majority of their employees working remotely, right? Work from home will probably become mainstream, and probably in certain cases mandatory for all companies, because really, if you see, you nowadays have all the tools which will enable you to work remotely, whether it is your video conferencing, whether it's your calls, your nets, your meetings, your collaboration tools, And all this has happened because of the rise in the cloud SaaS products and the cloud infrastructure, right? So I don't see me going back to physical kind of presence required to conduct businesses. A lot of the companies in Silicon Valley were working remotely 5 years ago also, right? It's not just that they've right now started working remotely. The question of company employee morale and things like that, that is happening right now because for us it's all new. But otherwise, if once it becomes a standard operating kind of business operating procedure, then there is no question of company of employee morale going down. I understand there is a need for a physical office. I understand there's a need for people to kind of socialize, meet, and physically kind of interact, which is required. But that doesn't mean that you need to choose either of the two, right? You can always have the best of both worlds, right? Depends upon where you see higher productivity and higher efficiency, right? So you probably see that.
Right. And what has happened is a lot of younger founders have now become wartime CEOs, right? And they're not being part of recessions. And, in 2007, 8 is when, 8 to 9 is when we had some sort of a recession in India as well. So, any advice for founders on how to go about this particular recession period, and what are your thoughts on how long would it be that we would go back to the normal times, if there are normal times?
See, that is anyone's guess. Like that, how long will we take to go back on for normal business? But surely there is going to be an impact or 2-quarter impact on the earnings, on the revenue for most of the companies. And as I said earlier, for some companies it will be higher, for some companies it will be low, but there will definitely be an impact. So you need to plan for the next 2 quarters for sure before there's some rebound happening and recovery happening. We would probably be in a recession, right? And that is still better than being in a depression, right? So founders need to just, as I said earlier, need to cut out all the expenses which are not required and extend their runways. But if you are in a business which is like a remote business, right, tools, then obviously this is a time for you to kind of hit the engine and kind of capture maximum market share and customers. But generally, 90% of the other businesses which have been impacted, the CEOs just need to kind of remain cool, keep in touch regularly with their employees, keep their morale high. If you have any technical debt outstanding, kind of complete that, build your product, research more, talk to more people, try to gather more market intelligence. And I think generally do things like that, and obviously listen to limited webinars and take limited advice. I think otherwise you just kind of don't know what to do and you get all confused. So just I think execute in a more long-term strategic way. More importantly, in the end, the sustainable profitability or sustainable business model is what you should probably aim to, and chalk out a plan at how do we go from here to a point where we actually probably do not need any external funding, right? If you reach that, then you have all the options open, right? And I think that's what most of the founders should do now.
Right, interesting. And you talked about remote tools, and your last investment had been in Airmeet, which is like a Zoom alternative. So how did that deal flow come to you, and why did you make investment in Airmeet?
Sure. So Airmeet is basically is an online conference tool as of now. Okay. So basically it's replicating the offline conference and recreating the entire experience online. It has a registration desk, a panel discussion, booths to showcase products, investor lounges where you can do one-to-one meetings, and between your networking breaks, between speaker sessions. So when I saw the product, I was in love with the product. It's a global product, can be sold anywhere sitting in India. You don't need an on-ground sales team to do that. It's low touch, high velocity. It's a complete tech product, so obviously high gross margins, perfect to what kind of things which we like. Has the ability to become like an enterprise product as well, the way Zoom has become with with more integrations and more features. So you can actually make that. So it's basically the UI, UX, the simplicity. The founders are great, and the world is going remote and accepting it, right? So it's just kind of been the right time. and solving a real problem, right? Because a lot of these offline conferences were not productive, right? So we love these kind of businesses, no operational intensity, no distribution cost, solving a real problem, and good set of investors as well, right? Axel and other good set of investors. And even the founders were very smart. They kind of, open it, like made it more like a party round, which is not a bad thing to do in a product like this, because the more the investors, the more the product will get known and people will share and people will talk about it more, your well-wishers in the market, right? So yeah, that's why we kind of invested. Yeah.
Got it. And earlier in the podcast, you talked about valuations might be down or it could be flat rounds. What advice would you give to founders on how to manage that?
So see, each founder is in a different situation. If you do not have the runway, I don't think so. You have a choice but to kind of accept a flat round, right?
Right.
Or a down round for that matter, because it's the tough things which you need to do during tough times, right? And take these steps to save your employees, your investors, your own dream. So there's nothing wrong in that, because in tough times these things do happen. It can bounce back. You could probably think about it as that, okay, let's recover it in the next round. Take this money, build it in such a great fashion that the next round could be 5x than what probably we could have done earlier. So kind of get that alpha from the next round, but the advice is to go ahead and take it, not to kind of keep trying and in the end not having enough money to run the company.
Right. And I quickly want to do the top three questions, which is, do you have any favorite business book?
So one book which I really enjoyed reading was 0 to 1 by Peter Thiel.
Right.
I know many people would recommend that, but I feel that there were a lot of counterintuitive insights when I read it. When I initially was starting to invest in early stage companies, I found some of the concepts there pretty interesting, and that's one of my favorite books, right?
Got it. And if you could go back in time when you started working on the fund or started the fund, what is the one thing you would have focused on or done anything differently?
So when it started off, I think in hindsight, the mistake which I did was I was somewhere in my mind looking at some safer bets, right? And but the asset class which I was like a early stage investing, right? So there's a power law which works there, and it's either go big or go home. It doesn't matter how many of your companies fail, but you need to find that one rocket ship or two rocket ship which returns the entire fund. So this learning happened a little later for me. Initially, I was looking at, okay, this company is not going to be 100x for me, but it's definitely going to be a 10x, right? And I'm definitely not going to lose money. So let me invest here. Might as well, I should have taken more riskier bets initially and not in my mind created that safety net, right? And probably should have tried to hit a home run on every ball. Yeah.
Very interesting. And do you have any favorite online tool? For example, Gmail, Slack, Zoom?
I love Trello actually. It's very simple, easy to manage, and collaborate with my team for deal flow. I love Google Sheet as well. I think it's simple, but it's pretty powerful tool. And lately, I've been using Notion and kind of liking it.
Got it. We'll put that in the show notes. So, what are the best way people reach out to you and get to know more about Gemba Capital?
The best way to reach out to me is through my email ID. It's Adith, ADITH @gembacapital.in. It's on my website, LinkedIn. I'm pretty active on Twitter, and obviously references are the best.
Awesome. Thank you so much for taking your time and speaking to us. I really enjoyed speaking to you.
Thank you for having me.
Thanks for listening to the Life Self-Mastery podcast, where we teach you how to start and grow your online business. For more information, visit Rohit's blog at www.lifeselfmastery.com.